All right, let's dive into a topic that can make or break a startup. Seriously, we're talking about SaaS accounting. Get this right, and it can be your greatest strategic asset. Get it wrong, and, well, it can tank your valuation. So let's get into it. So let's kick things off with a little scenario. Imagine your team just crushed it. You landed a $12,000 annual contract, and they paid the whole thing up front. The cash is sitting in your bank account right now. So here's the question. How much revenue did you actually make today? And here's where it gets interesting. The correct answer, the one that investors want to hear, is zero. A big, fat zero. Not 12 grand, nothing. And you know what? Understanding this one kind of counterintuitive idea is probably the single most important first step in SaaS finance. See, this is the fundamental difference, the big illusion. In a traditional business, you sell something, you get the cash, that's revenue. Boom, simple. But for a SaaS company, that is not how it works. Cash is not revenue. That $12,000 you just collected, it's actually a liability on your books, believe it or not an asset. This brings us straight to the golden rule of SaaS finance, revenue recognition. It's all about this huge mental shift from what you've collected to what you've actually earned. The official rule for this, if you're curious, is ASC 606, and it basically says you can only count revenue as you deliver the service. So booking that whole contract on day one doesn't just inflate your numbers, it messes up every single one of your key metrics. It's a massive red flag to investors because it tells them you don't actually understand the fundamentals of your own business model. So what do we call that cash you collected? The correct term is deferred revenue. And I absolutely love this analogy. Think of it like a prepaid gift card. Your customer gave you the money, but you haven't given them the value yet. You only get to earn it as they spend that gift card over the course of the year. Okay, so here's what that looks like in practice. In January, you collect the full $12,000. Great, but you only recognize 1,000 of it, 1/12. The other 11 grand, it just sits in that deferred revenue bucket. Then, every single month, like clockwork, you just move another $1,000 from the deferred bucket over to the recognized bucket until it's all earned. And oh, it gets way more complex. This isn't just about the main subscription fee. Founders trip up on this stuff all the time. They'll book a one-time setup fee immediately. Nope, that's wrong. You gotta spread it out. Or they'll expense a sales commission all at once. Wrong again. That also has to be matched to the contract term. Getting these little details right is the difference between having clean books and having an absolute nightmare during due diligence. So once you nail revenue recognition, you can finally start tracking the metrics that really truly matter. Think of these as the vital signs for your business, the numbers that tell you where you're really heading. And it all starts right here with MRR and ARR. Now, this isn't your total revenue. The key word here is recurring. It's the predictable part. We strip out all those one-time fees for things like setup or special projects so you can get a crystal clear, consistent picture of your core business's momentum. But just looking at your total MRR, that's not enough. The real story, the juicy details, are in the components. Your growth, your net new MRR, is this constant tug of war. You've got new customers and upgrades pulling you forward, while cancellations and downgrades are always trying to pull you back. Understanding that dynamic? It's everything. Now we get to pop the hood and look at your engine's efficiency. And that comes down to a little ratio called LTV to CAC. It answers one incredibly important question. Are you actually making more money from your customers than you're spending to get them in the first place? And let me tell you, in today's market, this is a bigger challenge than ever. The median time it takes to just break even on what you spent to get a new customer has stretched out to 20 months. Just let that sink in. You are funding nearly 2 years of costs before a new customer even starts to become profitable. This is why efficient growth isn't just a nice to have, it's a flat-out survival mechanism. This one right here might just be the most powerful metric in all of SaaS, net revenue retention. What's so cool about it is that it completely ignores new customers. It just asks a simple question. How much did my existing customer base grow or shrink? If your NRR is over 100%, you've hit something called negative churn. That means your upgrades are outpacing your losses. It's basically the holy grail for a SaaS business. Now check this out. This is a huge strategic insight. Companies with a low average revenue per account, we're talking under $25 a month, they actually tend to shrink over time with retention below 100%. But look what happens as you go up market. For accounts paying over $500 a month, the median jumps to 105%. So the big takeaway is that higher value customers aren't just bigger,
They are way, way stickier. Okay, so you've done the hard work. You've cleaned up your accounting. You're tracking all these core metrics. Why does it all matter so much? Because this is exactly what investors are looking at when they're trying to figure out what your company is actually worth.
Right. Investors don't just glance at your profit and loss statement. They use these SaaS metrics like an X-ray machine to see the real bone structure of your business. They want to see a predictable, efficient, and scalable growth engine. And having these clean metrics, that's your proof. And this financial discipline has a direct, tangible impact on your valuation. Right now, a median public SaaS company is trading at around 6 times its revenue. But look at the high performers in hot areas like AI or specific vertical SaaS. They can command multiples of 8x, 12x, or sometimes even higher. That is the financial reward for getting your house in order. Now, on the flip side, these are the deal killers. These are the landmines. When an investor sees messy revenue recognition, or you can't clearly explain your LTV to CAC, they don't just see a math problem. They see a bigger problem: operational immaturity and a ton of risk. And more often than not, they just walk away. So let's bring this all home with the final and honestly, the most important takeaway of all. It's about completely reframing how you even think about your company's finances. This quote from Igor Tudelman just hits the nail on the head. He says, the biggest mistake isn't technical, it's strategic. So many founders see accounting as this boring, necessary evil, this chore they have to do. But that mindset, it creates this cascade of missed opportunities that savvy investors spot from a mile away. So here's your playbook. It's really a 3-step path to turn your accounting from a liability into an asset. First, you set the foundation with proper revenue recognition right from day one. Don't wait. Second, you connect that clean financial data to your core SaaS metrics. And third, and this is the most important part, you use that whole picture to guide your strategy, everything from your pricing to who you hire to which customers you go after. And that leaves us with one last question, and it's for you to think about. When you look at your own company right now, is your accounting just a cost center, something that's holding you back? Or have you turned it in to your greatest strategic asset for driving real, sustainable growth? The choice and the opportunity is all yours.